Tax season, it is here. It can be confusing, complicated. We've asked an expert to help explain some common tax questions and some maybe not so common questions. Ryan Dodson, a certified public accountant with Staniland Dodson and Associates, is with us. Okay, so Ryan, there's a lot of tax information and misinformation, okay? And so there's something on social media that I want to call attention to right away. And this was a post, one of many posts actually that I have seen, that claims you can deduct the care of your pet. I bet there's some fine print that goes with that.
Absolutely there is, Tanya. So can you deduct your pet? Well, absolutely you can. However, you have to meet certain conditions to be able to make that deduction. And one of those is that pet has to qualify as like a medical deduction through the American Disabilities Act. And what that basically means is that it has to be there to provide a service, not comfort, but a service, such as it helps detect whether or not you're going to have a seizure, or it helps guide you because it's a guide dog because you're blind. It has to provide an absolute service, and that's one of the big requirements, and be able to deduct everything associated with your pet.
Yeah, that's why you can't just share every post that you see without actually looking at it, right? Okay. All right, I think a lot of people are seeing and hearing about the government layoffs. They're wondering how that's impacting tax season. So from what you're seeing, are refunds delayed in any way?
Tanya, that is mostly an automated process that the IRS sets up, and we have not seen any delays so far with anyone's refund. So everything, according to us, is just running as normal.
Okay, and so we should expect 21 days for our refund unless there's something complicated.
Correct. So 90% of all refunds are funded within 21 days, unless there's something rather complicated that's going on. The IRS decides, hey, look, we want to take an extra look at this, but that can happen, but not too often.
All right. So with refunds in mind, because everybody wants to know where their refund is, the best place to track your refund is the IRS, but you need to have certain key pieces of information to get that information.
Yes, you have to put in your social security number. You have to put in also what your filing status was, whether you chose single or had a household or married filing joint, and then you have to know the exact refund amount that you're expecting, and put that in, and then that'll of course tell you, hey, look, when to expect your refund.
Yeah, I think a lot of times people, maybe they do their taxes maybe online or something like that, and they just hit the send button and it's done, and they don't take down the information. So you need that information to make sure to check your refund. Okay, let's tackle this question. Most couples, they have a filing status of together, but sometimes that it's worth filing separately. So let's talk about those situations.
So it doesn't happen too often. I tell folks, hey, look, 98 times out of 100, it's probably best to file together on a married filing joint tax return. However, there are some occasions where it does make sense to filing separately, such as, let's say one spouse has a lot of medical expenses, and that's able to throw them over that threshold, so they're able to deduct those medical expenses. That's one good example of why I see a lot of couples may file married filing separate. Another married filing separate example would be, it's like if you have one spouse that incurred quite a bit of a tax liability and the other spouse does not want to be associated with it. So the other spouse files a tax return just with their information, and they're not responsible for their spouse's tax liability, because if they file jointly, well then guess the other spouse is now of course on the hook for that liability. And so those are the two cases where we say, hey, look, married filing separate is more advantageous than married filing jointly.
Gotcha. Okay, that's like if your spouse or you take out money from your 401k or something like that, and you're going to get a big tax hit, you might want to do that filing separately. All right, there's a lot of terms thrown around this time of year. Let's clarify what they mean. Let's talk about the difference between a tax credit and a tax deduction. We've got a little over a minute. Is one better than the other?
Tax credits are always better than tax deductions. If you get a $100 tax credit, that's $100 to your pocket, whereas a $100 tax deduction, you multiply that by your tax rate, call it 12%. Well, that's only $12 in your pocket. I'll take a credit for 100 more than a deduction for 12.
All right, and so there are a lot of tax credits that sometimes people don't claim because they don't know that they are supposed to get them.
Absolutely. Earned income credit is one of them, or a child independent care credit. Those are very popular ones that a lot of folks unexpectedly miss, but
you should take it. Take that tax credit. Make sure you look at it and double check it.
Yes, please do.
All right. Thank you for your time and your expertise, Ryan Dodson. We so appreciate that. If you missed any of this, you'll be able to find it in the 2 Wants to Know section of our website right now. We're going to check on that forecast, especially with that weather alert for tomorrow.